Hello students, welcome to CivicCentre. So today we will discuss about some of the important topics, especially from Indian economy, that too from current affairs perspective. So why this current affairs perspective is very important? If you look at the students' concerns, especially from competitive examinations, most of the students what they felt is the subject itself is very time consuming, and at the same time most of the students were lacking basic fundamentals about this subject. That's why at CivicCentre we have come up with a new initiative that is called Daily Economy Series. In this series, we will take up one daily current affairs initiative, and at the same time we will explore it through both prelims and at the same time mains point of view, so that you can understand the topic completely from both prelims and mains point of view. So coming to the discussion of today's the topic is nothing but corporate investment is very low in India. That is the topic, and that was recently seen in news. Because if you look at economic survey 2025, so what this economic survey has clearly mentioned is the corporate profits, especially corporate earnings, have risen, but at the same time the corporate investments, especially from gross fixed capital formation, whether it should be in the form of physical assets, digital assets, these were not eventually increased. That is the one of the major problem. And at the same time, the government has given many initiatives. Let's suppose if you look at capital expenditure. So from government of India side, the government has continuously pushed up this capital expenditure. Second one, interest rates. Lower interest rates are also giving some thrust to these investment criteria, and at the same time tax benefits. The government is providing tax benefits to these corporates, especially if they were under the startup category. So even though the government has come up with these initiatives, the index of industrial production fell to 1.2% in May 2025, which is very lowest in last 9 months. So this data was given by MASP, Ministry of Statistics and Program Implementation. So coming to the discussion, what were the reasons? So why is corporate investment lagging behind? The first one is lower consumer demand. So what should be the reason? The first one is after COVID-19, especially the pent-up demand for the goods, especially from industrial sector, they have been dwindled. That is one of the reason. Second one, the rising interest rates and inflation. That is also one of the major reason. Most of the industrial goods, they were not sold out in the market. That is the lower consumer demand. Whenever there is a low consumer demand, obviously the companies are not in a position to make new products. So that is one of the reason. Second one, underutilization of existing capacity. Already the companies are providing goods, and at the same time they have stocks. So if any consumer is not willing to buy these goods, then obviously the stock will not be overflown. That is also one of the underutilization of existing capital. Third one, slow export demand. So this might be understood by having knowledge on international relations, especially if you look at USA, Russia and some other Middle East nations. They were under constant wars. If you look at India's case, especially reciprocal tariffs were announced by Donald Trump's regime, so that the imports from India to US markets will be very costly. So when goods were very costly, obviously the people were look for alternatives. That's why it is also one of the reasons, slow export demand. The exports are going through different nations, but demand is very weak in that countries. Next one, delay in impact of capex projects. Capex is nothing but capital expenditure. So if you look at Government of India's perspective, especially roads, railways, ports, these are long gestational projects. Obviously, they need a long gestation, and at the same time, investments are also very high. Because the funds available in the market completely utilized for this capital expenditure, then obviously it will take longer times to realize their real potential and returns on investments. That is also one of the reasons. High import content in capex. So if you look at these capital expenditure projects, whatever the imports especially, these imports are mostly done through different countries. So sourcing through different countries, obviously the import bill will be very high. And at the same time, because of currency fluctuations, appreciation or depreciation, the imported inflation will also be very high. Imported inflation will also be very high. So the import content, especially whenever we are importing from any other nation, the import content is very high, and at the same time, repayment for that content will also be very high. So that is also one of the major reasons. Low labor intensity of projects. If you look at basic economic problem, what to produce, how to produce, and whom to produce. So what to produce, what are the goods and services that you need to produce in a economy, so that the potential purchasing power, who has the purchasing power, then they are only purchase your products. How to produce? So here there are two techniques, right? One is labor intensive sector and next one is capital intensive sector. Under labor intensive sector, if you take an example of agriculture or basic industries, majority of the agriculture and industries in India are running through labor, casual labor. So if you invest heavily in these labor intensive sectors, obviously you will create a better employment opportunities, better living standards, and at the same time savings will be happen. So that is the labor intensive. Next one is capital intensive. By replacing all human forces, what we will generally do? AI tools or robotics. By replacing all these human forces, we are going with capital intensive. So that is one of the major reasons why low developing economies, especially just like India and other southeastern nations, these are facing jobless growth. So low labor intensity of projects is also one of the major reasons. Low interest rates are not enough. So generally what we understood is, whenever any interest rates are low, generally what we will do? We will take loans. In a similar way, corporates or companies will also take loans, whether to expand their businesses or produce additional goods. But this is not real. So whenever there is interest rates are very low, people are taking loans. Here people or company, whatever it may be. So what they will do? They will simply transfer these funds into the stock markets. In recent times, these stock markets capitalization is very high. That's why if you look at household savings and at the same time corporate savings, most of the savings will be utilized for excessive financialization of capital markets. So whenever any company is taking out loans, obviously they does not have to be built into investments. So that is also one of the major issue. So what is the way forward to counter these effects? The first one is increase government expenditure. So whenever government wants to expenditure on its capital expenditures, capex, so there is always a problem of crowding effect. What is crowding out effect? Nothing but these are two entities. One is government and second one is private. The availability of money or supply of money is very limited, right? So most of the money will be taken by government itself. Then only less portion of money supply will be available to these corporates. So obviously whenever there is less money supply, your simple demand and supply mathematics, right? Whenever any product is very less in supply, then obviously the prices will be very high. In a similar way, the interest rates on these loans will be very high. Whenever these interest rates are very high, obviously private sectors are not in a position to invest in your capital expenditure markets. That is also one of the major problem with the increase in government expenditure. Focus on reviving demand. How you will revive the demand? The traditional methods. Cash flow to the public. Just like your MNREGA scheme. Or increase the additional days, especially this was for 100 days. Let's say if you kept it 150 days, then obviously the demand will be pent up. That is the one way. Second one, taxes. If you reduce the tax burden on general public and at the same time companies, then obviously there is a additional money supply. Purchasing power will be very high with the public. Obviously they will demand the products. Whenever there is demand for any particular goods, obviously the companies will produce the goods. So to produce these goods, obviously employment will be created. That is also one of the major area. Next one, prioritize short-term gestation projects. The government should focus on short-term projects so that it will have a real impact on economy. So if you take long-term gestational projects, obviously the investments will be very high, interest rates will be very high, and at the same time the employment opportunities are in long term is very high. If you take in a short term gestational projects especially, then obviously these will also be available at short term projects also. Minimize import content. So India is a net importer country. What does that mean? Majority of energy security we are importing from different nations. According to IMF, almost 85 to 90% of our imports are met with different countries. So obviously to reduce import content, obviously you need to strengthen your domestic policies, especially Make in India. Atmanirbhar Bharat Yojana. After COVID-19, the government has announced a package to revive the industries so that we should reduce the imports, so that import dependency will be reduced and at the same time our current account deficits will be controlled. That is the import content. Promote labor intensive sector. Most of the times what government has generally done is mostly focusing upon to give employ to labor. So majority of the times labor intensive sectors will be promoted so that the problem of reviving of these investments will be revived. Restore credit flow. How you can restore credit flow? By reducing interest rates. The first one is by reducing interest rates, and second one is prioritizing sector lending certificates. Through banks and other financial institutions, you can restore credit flow to the needy sectors in right time so that they can invest in whether physical capital or social capital. So this is the main practice question that we can expect. Do you agree that public investment alone cannot sustain economic recovery unless accompanied by a revival in corporate investment? Substantiate with reasons. So this is the practice question that you need to practice, and at the same time in another next session we will provide the complete details about this mains practice question. And next one practice question. With reference to sluggish corporate investment in India, consider the following statements. Low interest rates automatically result in higher private investment as borrowing becomes cheaper. This has already we have discussed. High import content in capital expenditure reduces the multiplier effect on domestic demand. Underutilization of existing industrial capacity acts as a deterrent to fresh private investment. Increased government capital expenditure immediately crowds in private investments. So the first one, low interest rates generally does not automatically convert it into high private investments, because the private players generally they will wait until the demand revives. That is one of the issue. Second one, they will pay off their debts. Nothing but evergreening of loans. So technically first one is incorrect. High import content in capital expenditure reduces multiplier effect on domestic demand. This is traditionally correct statement. Underutilization of existing industrial capacity acts as a deterrent to fresh private investments. This is also have discussed. Increased government expenditure immediately crowds in private investments. So whenever you found any immediate or only, so generally these statements are negative. So this is also negative statements. So the correct answer would be 2 and 3. So that is the discussion for low investment. Why corporate investments are very low in India? What are the different steps that have been taken by government of India, especially to revive this demand? And at the same time, what was the role played by general public and general society? So that is the class for today's discussion. Thank you for watching class. Have a nice day.